Welcome back to Wealth Science Sphere, your go-to channel for insights into the intricate world of finance and economics. Today, we're diving deep into the fascinating topic of currency depreciation and its impact on the stock market. Currency depreciation can be a complex phenomenon influenced by various economic factors. In this video, we'll explore its causes, effects on stock prices, inflation dynamics, relationship with interest rates, and strategic approaches for traders. But first, let's understand what currency depreciation is. Currency depreciation refers to a decrease in the value of a country's currency relative to other currencies in the foreign exchange market. There are several reasons why a currency might depreciate. Factors such as trade imbalances, weak economic fundamentals, loose monetary policy, and political instability can contribute to currency depreciation. Let's dive deeper in each causes one by one. Trade imbalances. Persistent trade deficits can weaken a country's currency as it indicates a higher demand for foreign goods, leading to an outflow of domestic currency to pay for imports. Economic fundamentals. Weak economic indicators such as low GDP growth, high inflation, and high unemployment can erode investor confidence, leading to capital flight and currency depreciation. Monetary policy. Loose monetary policy, characterized by low interest rates and expansionary measures such as quantitative easing, can devalue a currency by increasing its supply. Political instability, political uncertainty, conflicts, or governance issues can undermine investor confidence and lead to currency depreciation as investors seek safer havens. Now let's discuss how currency depreciation affects the stock market. It can have both positive and negative effects. Stocks of export-oriented companies may benefit from a weaker currency as their goods become more competitive in foreign markets, potentially boosting revenues and profits. Additionally, companies with significant foreign earnings may see an increase in translated profits when converting back to the domestic currency, thereby increases their stock prices. However, import-dependent companies may face higher costs for imported raw materials and components, squeezing profit margins, and consequentially decrease their stock prices. Furthermore, currency depreciation can lead to inflationary pressures, increasing input costs and reducing consumer purchasing power, which can dampen domestic demand and overall economic activity. Currency depreciation can also impact inflation dynamics through cost push and demand pull mechanisms. Cost push inflation. A weaker currency can increase the cost of imported goods and raw materials, leading to higher production costs for businesses, which may be passed on to consumers in the form of higher prices. Demand pull inflation. Currency depreciation can boost exports by making them cheaper for foreign buyers, leading to increased demand for domestic goods and potentially straining domestic supply, thereby fueling inflationary pressures. The relationship between currency and interest rates can influence investor behavior and market dynamics. Interest rate differentials. Higher interest rates relative to other countries can attract foreign capital inflows, strengthening the domestic currency, which then dampens stock market performance. Conversely, lower interest rates may lead to capital outflows and currency depreciation, thereby increases stock performance. Central bank interventions. Central banks may adjust interest rates to influence currency values, such as raising rates to support a depreciating currency or lowering rates to stimulate economic activity and exports. Next, let us dissect the impact of currency on bond prices. The relationship between currency and bond prices is complex and influenced by various factors including interest rates, inflation, and market sentiment. Generally, when interest rates rise, bond prices tend to fall. As investors seek higher yields, elsewhere, which can also lead to a strengthening of the currency. Conversely, when interest rates decrease, bond prices tend to rise, potentially leading to a weakening of the currency. However, the relationship can be influenced by other factors such as economic growth, geopolitical events, and central bank policies. Let us look at examples from emerging markets, including Africa, Turkey. In recent years, Turkey has experienced significant currency depreciation due to political instability, high inflation, and trade imbalances. This depreciation has had mixed effects on the stock market, with export-oriented sectors benefiting while import-dependent industries face challenges. Argentina. Argentina has a history of currency volatility and depreciation, driven by fiscal imbalances, high inflation, and external debt issues. Currency depreciation has contributed to inflationary pressures and economic uncertainty impacting investor confidence and stock market performance. South Africa has faced currency depreciation amid structural challenges such as high unemployment, income inequality, and fiscal deficits. This depreciation has affected various sectors differently, with exporters potentially benefiting while importers and consumers face higher costs. So, how can traders navigate the stock market amidst currency depreciation? Diversification, hedging, and focusing on export-oriented sectors are key strategies. Traders can adopt several strategies to navigate the stock market during periods of currency depreciation, particularly for companies with significant exposure to foreign markets. Focus on export-oriented sectors, favor industries that benefit from a weaker currency, such as exporters of commodities, technology, or tourism-related services. Monitor macroeconomic indicators. Stay informed about economic fundamentals, monetary policy decisions, and geopolitical developments that may impact currency values and stock market performance. In conclusion, currency depreciation can have significant implications for stock market performance, inflation dynamics, and macroeconomic stability. Traders and investors need to carefully consider the underlying causes of currency depreciation, its impact on different sectors, and adopt appropriate strategies to navigate market volatility and mitigate risks. Additionally, policymakers play a crucial role in addressing structural imbalances and implementing measures to support currency stability and sustainable economic growth.